Yeah, ladies and gentlemen, welcome back to the channel. This is, as you probably already saw from the title again, General Introduction to Tax Law. We are going to close the gap between the chapters. This is now subchapter 4.6, and this is from informing you about how the tax is to be paid. Until now, we spoke about tax base, tax rate, and all the stuff, how the tax base is computed, and now how is the payment effectuated. Well, let's first repeat some basics. You remember that the income tax is levied for a whole calendar year. That is something you can read up in paragraph 2, section 7 of the EStG. The income tax is levied for a year. So all the income of the year will be summed up with the only exception of income from capital, which is taxed with a flat rate and separately. I already told you that. But everything else is added up. Positive and negative results of all types of income are added up. First, all results within one type of income are added, and then the result from the different types of income will be added up. At the end of the year, then, your total income tax will be computed according to the tariff. That is that function which we already know, let's say 45% on everything minus a correction factor for the first part of the income, which are taxed at a lower rate, or 42% times all your income minus a correcting factor for the cheaper regions of your income, and so on, or even 0% if you are within the range of the basic allowance. So if your annual income in the total is lower than what you need to live or survive in Germany, then your tax rate will be set as 0. Now, how does that work? Especially, or in the basics, or in detail, you probably remember that you have a taxable income, but when it comes to the tax rate shall be orientated it shall orientate itself on the amount how rich you really are. So the rich people shall pay a high rate, the poor ones a low rate, and the medium people in the middle shall pay a middle rate. Well, and now if you have also some tax-free revenue, then naturally the taxable income does not really reflect your total amount of wealth. So there will be an auxiliary calculation made, which we already mentioned. That is the auxiliary calculation where you determine the adequate progression for a taxpayer with that personal wealth. The idea is then you do as if most of the tax exemptions did not exist. You find out what the whole worldwide income of the taxpayer then would be, and then you calculate what the taxpayer would have to pay in that case. So in order to do this, you would have to increase the total taxable income again by all or nearly all of the amounts which were left tax-free during the computation of your taxable income in order to find out how high or low the wealth of that person really is. Special expenses and extraordinary expenses are naturally also granted during that auxiliary calculation, because if everything were tax-free, taxable, which you had in the world, you still could deduct special expenses and extraordinary expenses. Furthermore, the amount of your loss carry forward, which you deducted and which you calculated based on your taxable income, remains unchanged, because naturally, if there is a deduction made for your loss carry forward, well, even if all your worldwide income were taxable, one fact remains. In final effect, you don't get deducted more than the 60% or so on your taxable income. So one does not deduct a higher loss carry forward from your worldwide income if you do that auxiliary calculation. Now, basically, all income which is tax-free will be taken into account to calculate your total wealth, and so to determine your tax rate. Only for reasons of legal certainty, we have a long list of all the tax-free items which are taken into account to calculate the tax rate. Yeah, there are only very few exceptions from the inclusion of tax-free amounts into the tax rate calculation. And there are only few reasons which justify that. First, tax-free amounts can be excluded from the tax rate calculation if the only reason why you let that amount tax-free, or one of the major reasons why you didn't declare it taxable, is just that you wanted to save the people to work to compute the amount correctly. There are some tax exemptions in Germany which are only explicable from the wish of the tax legislator to spare the people the work to calculate that correctly. For example, the value of the private use of a business bicycle, which the employer gives to an employee for business purposes and which that employee now can also use for private purposes. In principle, that's a financial advantage which you can obtain because you are an employee, so it's a revenue and it would be taxable. But having to compute that individually, demanding a logbook showing how often you use the business bicycle for private purposes, calculating the cost of the bicycle per kilometer and so on, that's bureaucracy like hell. And what comes out is probably €1 or €2 of taxes per month. And so one just declared that taxable to save the people and the tax offices the work. Naturally, when that's the motive, you don't demand the calculation for the tax rate. That would be rubbish. It would spoil the whole effect of the whole exemption. The same if you use a business telephone to make a private call and you have a flat rate, for example, which is very frequent. Now you have an employee gets a business telephone because for business reasons, for job reasons, you need to be available to your employer at any time or so, or the employer just thinks it appropriate. Then you have a mobile phone, for example, received from your employer. Now you also do come from private calls. Now that's a financial advantage. You save the costs of an own telephone or of an own second telephone. Now that's a problem. How high is the financial advantage? Well, if you were to deal exactly with the matter, one would do a traditional cost accounting. Let's say the mobile phone flat rate costs some €50 per month. Then you would have to documentate how many telephone calls you do for business purposes, let's say 500, and how many you do for private purposes, let's say 100. So 1/6 of the cost would refer to your private usage of the telephone. And so let's say some €5 or €4 would be a financial advantage from the usage of that business telephone for you, the employee. And just in order to determine that, you would have to make a list of all the telephone calls, writing down all the 600 telephone calls during the month, in order to determine during each month the proportion of the costs which refers to your private usage of the telephone. You would probably rather prefer to shoot yourself than doing this. And also a tax inspector would rather probably try to drop down dead instead of checking if your list with the telephone calls was complete or manipulated. So it would be a complete waste of working time and nerves to demand the correct taxation of that small financial advantage which an employee gets from the usage of a business telephone given by an employer to him or her. And then, so that's the reason for the tax exemption. The same tips which you give to waiters are in principle in the hands of the waiter, a financial advantage which is caused by the employment relationship. You don't get it from your employer, but you get it because you work for the employer. Customers are very satisfied with your services, give you a tip. Now the problem is it's nearly not possible to documentate correctly all the tips, and if you would really control that properly, it would end up in endless chicane and bureaucracy for all the people involved, and sorry, and you would probably have to arrest half of the population working in restaurants for tax fraud, suspicions of tax fraud, or for just being idiots. They would probably refuse to take tips and so on. And so just to get rid of the calculation problem, you also have an exception there. If that's this type of exception, it's clear that you don't demand a calculation for tax rate purposes, because then it would spoil the whole effect. So this explains that some minor tax exemptions are not taken into account when you calculate the tax rate. The other category of exemptions which is ignored too when it comes to tax rate calculation is certain tax exemptions which, if you would include them into the tax rate calculation, would enable the people involved in to use them for a tax saving model, something which is far too difficult for beginners. You can only take it for granted that there are certain exemptions where, if you use them very, very intelligently, which then would enable a taxpayer to lower the tax in an illegitimate way. If these things were taken into account during the tax rate calculation, that happens with some very few exceptions in double taxation treaties, not with most of them. Especially when you have income from risk-free sources, so-called passive sources, in the European Union, which are tax-free under a double taxation treaty, then these things could be used for a tax-saving model under very restricted circumstances. And so there is a list of certain tax-free EU income which is not even taken into account but ignored when you calculate the tax rate. For beginners, memorizing which items these are is far too complicated. For beginners, the rule must be every tax-free item which is declared under a tax-free under a double taxation treaty will have to be taken into account for the calculation of the tax rate. Full stop. And if there is an exception, one has to tell that to you in a task, clearly and explicitly. All other things would be chicane. Because I came across tax officers working in the tax administration, who also 5 years after these rules have been introduced, completely misunderstood it, or yes, were still completely confused with that. And so for beginners, this is a no-go. For beginners, the rule is if you don't have an exemption, which is category 1, calculation simplification exemptions, the waiter's tips, the private bicycle usage, and things of trifles of that kind. If you have something else, another tax exemption, it will always be taken into account as a part of your worldwide income when it comes to the calculation of the appropriate tax rate. So let us have a look on how that would work, the definitive calculation of the final tax after you hand it in your tax declaration. Imagine you have a house in Munich, you earned 30,000. Now you have column 1, the total taxable income, and indeed the house counts 30,000. And the tax rate relevant income for the auxiliary calculation, which tax rate will be appropriate for you personally. 30,000 taxable, naturally it counts. What is taxable is always relevant for your total worldwide income too. The factory in Munich income from business, 70,000. It counts for the taxable income because it's not tax-free. And then total tax rate relevant income, also naturally it's 70,000. Now a factory in France, 500,000. In basic principle, everything which you earn all over the world is taxable in Germany. So the 500,000 are income from business. Now, a very special rule, the double taxation treaty between Germany and France, shall say Germany renounces on taxes for these 500,000 because the French already plunder it sufficiently. So it would be tax-free in Germany. Nevertheless, it is a part of your worldwide income. It's tax-free in Germany, but it's a part of your worldwide income. And if I want to determine if you are rich, very rich, medium rich, or extremely poor, then I should take that income into account. So for the tax rate relevant income, for the auxiliary calculation for your tax rate determination, we take the 500,000 into account. Then you have a rent from a big office building in France, and now, well, it is, for example, a skyscraper, and you finance it on credit. So you have high interest amounts in the first years, and perhaps you have increased depreciations during the first years, or whatever may be the case. Now it's not the German problem because that rent is tax-free. It's only taxed under French law, again according to the double taxation treaty. Basically, it's a part of the worldwide income. The basic rule says it should be taxable. Okay. But a special rule, the double taxation treaty, says tax-free. Now, this would be a case where the proviso safeguarding progression is excluded due to the fact that several people have started some very ingenious tax saving constructions using the fact that formerly these things were included into the tax rate calculation. So the minus 600,000 from France will also be ignored, not only in the taxable income calculation due to the special rule, but also during the tax rate relevant calculation, the progressivity calculation. So also there a zero, but only, and I underline that, only because I explicitly said that this is an exception. Normally, like the factory in France, everything is part of your worldwide income. And if such an item of income is declared tax-free, it nevertheless shall be taken into account for your tax rate calculation, only if an explicit special rule says, no, leave it out, we fear some tax-saving constructions where the taxpayer is going to trick us. There you have again an exception. So when you look at the two columns, the first one, which we now take into account, is the tax rate relevant income, because you need that for the auxiliary calculation for the tax rate. If you take into account all the worldwide income, which counts for the progression calculation, then you end up with a total of 600,000. Now you would, in the next step, to ask yourself, what would 600,000 normally cost? And I looked that up with the data for 2020. To next year, it will be different. And so next year, after next year again, the tariff will be a bit adjusted, but then look it up in the current tax tariff. Here, an amount of 250,921 euro and 22 cents comes out. The 22 cents will be ignored. Yeah. And now we can find out how much percent would that be. So you divide the 252,921 by the progression relevant income of 600,000 and end up with, if I calculated this correctly, a percentage of 42%, comma, or dot 15354%. Now you know that from the German tax law's perspective, if somebody has a worldwide income of 600,000 euro, that person is so rich that we regard a tax rate of 42%, 0.15354% as adequate for a person being so rich. Now we apply that adequate tax rate to the taxable income of that person, 100,000. And that leads to a tax claim of 42 and blah blah percent of the 100,000. So 42,153 euro. Here you see that the reason, by the way, why I did not round it down to 42% even, flat, because the few digits after the comma still make a difference here in my example of 153 euro. So naturally, rounding down is not really done when it comes to the tax rate calculation. There, some 3 or 4 digits behind the comma may make a huge financial difference, so probably don't round down. Take as many digits behind the comma as you can. It might be that the fiscal administration internally has some rules on rounding up or down, or where they stop using the digits, but for us, when it comes to understanding how it works, that does not really matter, and probably nobody really cares about it. Only the administration probably needs a directive how many digits they are forced to work with. We not. Again, another example. Let's vary this stuff a bit. For example, now we have a house in Munich and the factory in Munich, same income situation, the factory in France. And now the rent from the big office building in France is positive. But here again, we have a special rule which says it's tax-free. And as it is passive income from the EU and tax-free, it will also be ignored during the tax rate calculation. In that case, you have again exactly the same result as before. And that's the case. So, okay. Let's go on. Here's another case. This time we have to do with a splitting case. Just to remind you of the splitting tariff procedure called joint assessment. You remember that was paragraph 26 of the German Income Tax Code. That a married couple can apply for joint assessment. That means that their income is added together and then that every spouse is taxed as if he or she had earned half of the total income of both, so that the average income of the two spouses is the tax base for the tax of both of them. And now, in this case, spouse number 1 and spouse number 2 both have a job in the inland, 60 and 40,000, together 100,000. This is clearly taxable because there is no exemption. It also counts for the proviso calculation because what is taxable is always relevant for the tax rate for the progression too. Then spouse number 1 has a share in a factory in Munich and there a profit is 3 million. And spouse number 2 is also probably a child from rich parents or from a rich family, one never knows if it were the grandparents or the grandparents, but there is a share in an OHG in France. And now, unfortunately, that OHG had a bad year, minus 1 million, so a loss is her share in the profit of the OHG. Under the double taxation treaty with Germany, that share is declared as tax-free, so a tax-free amount counts with a 0. But on the other hand, when it comes to the progression calculation, you take everything of the worldwide income into account, which is not explicitly excluded here. And so for the proviso calculation, we take the 3 million into account, which are tax-free. which are taxable, plus the minus 1 million, which is tax-free. So there we have 2 million worldwide income for business. Now our spouses have additional income. A house in France, spouse number one, the rent income is 40,000. This is income from lease and rent in theory. It is a part of the worldwide income, but it's not taxable because a special rule, the double taxation treaty with France, excludes it from taxability and declares it tax-free. Now for the tax rate computation, surprise, it's also declared as irrelevant under the very special rule for the avoidance of EU-based tax saving model from passive income. You know, that was what I just told you. And you know that you as beginners do not have to identify these cases. You just take for granted everything which is tax-free usually also counts for the tax rate calculation, only if I'm told something different. And here I'm totally telling you something different, not relevant for the tax rate. So even in the progression column, we leave it out. So we have tax-free income here, 0, and tax rate 0. Spouse number 2 has a factory in Belgium, so our couple gets richer and richer, unnoticed by us before. The factory in Belgium has a gain or a profit of 800,000. Part of the worldwide income as income from business, but declared tax-free under the DTT with Belgium. And this is automatically tax-free, so relevant for the tax rate because I don't tell you something to the contrary. So for the tax rate calculation, we take 800,000 into account, right column here. Let's sum it up. A subtotal for all the income from the 7 types of income is 3.1 million. And as we have some tax-free income in the tax-free area, the whole worldwide income is rather lower than the taxable part of it in Germany. Happens. Okay. A next step, a loss carry forward, is still existing for the married couple from the last years. 5 million is left over, yet unsettled. So we have to test what we can deduct. The total income of the both spouses together taxable is 3.1 million. And every taxpayer can deduct up to 1 million. So with a tax-free married couple, we can deduct 2 million. From the remaining amount for both, 1.1 million is left for both of them together. 60% can be set off and netted off against the loss carry forward, if the loss carry forward is still high enough. That leads to a maximum of 660,000, and we still have a loss carry forward of 5 million minus 2 million used again. So 3 million is left over. That's far more than sufficient, so we can still deduct the 660,000. In addition to that, our couple has some special expenses. These can also be deducted from the taxable income and from in the proviso calculation. Naturally, they also count because that's also a part of the worldwide income. Yeah, so we end up with a taxable base of 400,000 for both spouses together, and their worldwide income taken together is 200,000, relevant for the tax rate. Now, remember that the splitting procedure means we take half of it for the calculation for both of the spouses. So the assumption is now every spouse gets half of the income, so the average income of the spouses counts. That leads to 200,000 which are taxable per spouse. And for the tax rate, we take half of the progression relevant number of 200,000. That means for the calculation of the tax rate, we have to calculate what would a taxpayer, a single person earning a worldwide income of 100,000, have to pay. Based on 2020 figures, that would be 33,036 euro. If you see this video later, 2021, 22, 23, or even in 2055, just take the current tax tariff and adjust the things accordingly. Yeah? The only reason why we did that whole calculation with the right column, the proviso column, was we wanted to find out how rich or poor our spouses were and which tax rate they deserve for that. And their worldwide income per spouse is now this year 100,000. This corresponds to a tax of 33,036. And the only reason why we did this was to compute the percentage. This is 33.036%. And this is so the adequate tax rate for people with that wealth. And now we apply that tax rate to the taxable income in Germany. In that case, this is even 200,000 happens. So within Germany, they were rather rich, but in the rest of the world, they became poorer. So yeah, that was the reason. The 200,000 are then taxed with their adequate tax rate, 33%. That leads to 66 probably per spouse, and taken twice because we have two spouses with 200,000 each, we end up with a total tax burden of 132,144. Okay. Yeah. Now this is how the fiscal administration in the end will determine your final tax rate. Either single assessment or joint assessment for married couples. Now they know what they have to claim, but the other question is, how do you collect the amount? And this is the main topic of this chapter. There's one problem. If after the year you approach the people and say, hey, you owe us 132,000 and some minor amounts of money, then the average taxpayer says, yeah, nice to know now, the money's gone. Was casino and holiday and a new car, and so everything's gone. So your only possibility which you have is, or the most realistic way to ensure the tax payment proper, is that you ask for prepayments during the year in a way that when you make the final tax assessment, so when you calculate the correct figure, only a small amount is left over, or even nothing is left over, which you still have to claim, that you even can say you paid too much in advance, here is some money back. And so prepayments must be claimed during the year. And yeah, that's indeed done by every modern state. So tax prepayments are levied in different ways. The most important one is, because the most people are employed in a job, the tax prepayment levied on wages. This is called wage tax, in German Lohnsteuer, but this is not a separate tax. This is just the prepayment which you month by month do for your annual tax income tax. The wage tax has to be computed by your employer. It has to be deducted from your gross wage, so you don't get your full wage because a bit is taken, put aside by your employer, and then transferred in your name to the fiscal office. So your employer is forced to make in your name a prepayment for your annual income tax. The amount is explicitly and clearly stated in legal rules, so there is no discretion, no choice. Your employer has to do it. Now, if your employer does not withhold the wage tax from your wage but pays out the wage completely, he or she will be held liable for the damage. Imagine 4,000 euro was your wage. Your employer gave you the full 4,000 euro and didn't deduct, let's say, 1,000 euro, which was wage tax. And when the fiscal office knocks on your door, you say, oh, money's gone. Holidays, casino, bars. new car, everything drunken and spent, then by the negligence of the employer, the fiscal office lost its money, and so they will hold the employer liable for the damage. So they knock on his or her door and say, hey, due to your fault, we didn't get our 1,000 euro, give them to us. You are liable for the damage, and then you can hope to get the 1,000 euro back from the employee to whom you paid too much. Our claims will have to be settled because we as a state, we have a claim. Now, if your employer even on purpose doesn't pay the full withholding tax, that would be tax fraud even, because you don't inform the fiscal office of the correct amount of wages, you don't get assessed on the full wage tax, you as the employer, and so by that behavior, a tax advantage was generated. The tax was paid to the fiscal office either not at all or later than demanded, delay of several months. That would be sufficient for an accusation on grounds of tax fraud, and naturally with wage tax, which is the highest, one of the highest sources of revenue in Germany, and so widespread, they are not going to tolerate negligence, and so there will be some problems. The second important way to levy prepayments is for people who receive income from capital. There, I already mentioned income from capital is very often taxed with 25%, a flat rate, and also there one uses a similar system. People who pay out dividends or interests have to split the dividend or interest payment into two parts. The first one is a prepayment of 25%, so-called capital income tax. In German, the word is Kapitalertragssteuer, or abbreviation CAP EST, or KEST, both would be found. So when 1,000 euro dividend have to be paid out, the company which pays you the dividend is not allowed to give you the 1,000 in one single amount. They have to split it up. 250, so the 25% prepayment, have to be held back, and to be transferred to the bank account of the fiscal authorities in your name as prepayment for your tax on the capital income, and the rest can be paid out to you on your bank account. That obligation is put on every person paying out dividends, interest, or similar remunerations in Germany, or taking part in the payment of these. If they don't withhold the capital income tax from these payments, same mechanism as with the wage tax, they are liable for the damage which is caused by that. So if an inspector comes and sees their books and sees, well, they paid out a dividend of 1,000 euro without the deduction of capital income tax, they directly say, you caused us a damage, we have not yet received that money, please compensate us for the damage, pay the capital income tax now, and then try to get the money back from the person to whom you paid out the dividend or the interest in full. We wish you good luck. So you are liable for that. And again, if you willfully not declare capital income tax and not withhold it, then that is tax fraud, because you violate your tax obligations. And by your non-compliance, a tax advantage begins to exist which is not compatible with the law. The recipient of capital income does not pay the tax on the capital in time, but delayed or not at all. So you will be held liable for the damage, and if one can prove you did it on purpose, then it's also a criminal offense. You might go to prison. Only a few persons are freed from the obligation to withhold capital income tax. some private persons or so where the legislator sees there is no realistic chance that these people could comply with the rules, so they are exempted. But all the rest has to withhold capital income tax. By the way, for wage tax withholding, there is nearly no exception at all, or as far as I know, every employer has to withhold them. Even a private household who employs somebody on a regular basis would have to withhold and pay wage taxes, because the idea is whoever acts as an employer must be able to comply with legal rules. An employer is always supposed to be able to read and write and to fulfill tax duties. That's it. Whereas in the field of capital income tax, there is theoretically the possibility that you lend to your brother an amount of 10,000 euro for an annual interest of, let's say, 3%, and that your brother now pays 300 euro or so to you as interest and does not know about capital income tax. So there might be some private persons or small institutions for whom capital income tax rules are too complicated, but all the rest, all the professionals have to withhold it. Especially every company which pays a dividend must know about capital income tax. That's absolutely clear. Another way where a compulsory prepayment is demanded is the so-called Bauabzugssteuer, the building activities withholding tax, which exists also here in Germany. I'm now speaking only about German law, do you know? A person who pays for the work done on a building, either construction work, repairs, painting the walls and so, repairing the facades, the roof and all that. In all that cases, a person paying an invoice to such a business, such a worker, has to determine first the gross amount of the payment, so net remuneration plus value-added tax. And then you have to compute 15% of that gross amount and to hold that back from the invoice, to transfer that 15% to the fiscal administration and only to pay the 85% of the invoice amount directly to the bank account of the person who did the building activities for you. That building activities withholding tax serves as a prepayment for the own income tax of the enterprise which worked for you, and for a series of other potential financial liabilities of that enterprise to the German state. So when you owe somebody for construction of a house a payment of 100,000, you have to hold back for 15,000 for the fisc, and only the rest 85,000 has to be handed over to the other firm. Naturally, for the 15,000, you give them a receipt, an attestation where you name or certify that you paid that amount in their name to a fiscal office, and you name your tax numbers and you identify the fiscal office so that it later can be checked that everything was correct and that you did not put the 15,000 just into your own pockets. Only entrepreneurs are expected to follow the rules of the building activities withholding tax, and certain small enterprises are even exempted from them. And another aspect is important: firms in the construction or repairs business or so can obtain a certificate from the German fiscal authorities which attestates them that they are reliable taxpayers which will do their prepayments on their own, and then you can pay money out to them without deduction of the withholding tax, and most construction area firms do it. Mostly foreign firms which are new in the market have not yet obtained such a certificate, which they can show to you and which you can then take and copy and store as a proof that the transaction was free of the withholding tax. So mostly foreigners are hit by the tax until they get familiar with the rules. And naturally, as this is so rare in practice, this is always a high risk that somebody overlooks. For example, that one can only pay out the full amount for such working activities to such people if there is the attestation available from the fiscal authorities that you are allowed to pay out a certain amount without the deduction to that firm. Good. And very often you have also special rules, special withholding taxes, which are only applied to payments made to limited liability taxpayers, especially to those where the activities are very plausible not to be taxed fully in the future, or where the taxpayers will probably not fully pay. Remunerations for artists and entertainers. Well, if after the end of the year you go to an artist or an entertainer and say, hey, you earned $1 million in Germany, where's the money? And probably entertainer says, first, I'm in New York, you can't get me. Second, where's the money gone? Hey, all into drugs and cocaine. And did you see my famous gig somewhere? And I was full with excellent cocaine of the best quality, and that is where the money went. So probably you can't hope to get the money. So there is a withholding tax introduced for the payments to these people. See Chapter 6. In 50A EStG, in Germany, you have 15% to withhold from payments made to these people. Royalties for inventors or for artists or for writers, which are paid out to people living outside Germany. Also there it's difficult to get the money from them, so a withholding tax is also to be followed, to be kept back from all payments which you do to people like these. And if you have a foreign member in an inland supervisory board of a stock corporation, you also have to split the payment. Then 30% go to the fisc as a prepayment for the income tax of that supervisory board member, and only the rest can be paid out in full. Well, so that is how prepayments are organized in a standardized way. And now naturally there are income parts, income items, which are not covered by any of these prepayment mechanisms, by any withholding tax. And for all the income types which are not yet covered by one of these prepayment mechanisms, the taxpayer is asked in advance by the fiscal office to make prepayments for these amounts of income. And they just calculate individually which tax might be expected from you for these remaining items of income. And naturally, as one does not yet know your actual income, your current income of this year, one has to base the prepayment calculation on an estimate. And the best estimate which you have is how did it go last year? Which sources of income did you have? What did you earn? We assume this year it will be similar, so we assess you on the same amount for this year and calculate a prepayment and demand this from you for this income during this year. For example, that would work this way. Imagine a taxpayer has a job with an income from 100,000. Yeah? It must be allowed to dream a bit. And now plus an income from 30,000 from a house which is let to tenants. Now the 100,000 income will be covered by the wage tax. So the wage tax will take care of the 100,000 in a way which automatically leads to sufficient prepayments for this part of your income. Now the fiscal office says, okay, let's calculate what will be the additional amount due for the exceeding 30,000 from the house. So they say you will have a total annual income probably this year of 130, because we assume it's the same income as last year, 100,000 plus the 30. So your total income tax will be probably 130,000 taken by 42% minus a correcting factor for these areas of the income which are taxed at a lower level. And then it comes out 45,636. That is the figure for 2020. Yeah, 45,36. Good, you know what I mean. Now, the 100,000 lead already to 33,036. So the additional 30,000 caused the increase from 33 to 45. And so just the difference will be caused by the 30,000, and this is 12,600. So the fiscal office says, okay, your 30,000 will cause additional income taxes of 12,600. That leads us to a claim for a prepayment every 3 months, every quarter of a year, of 1/4 of that, that is 3,150. Pay it in March, pay it in June, pay it in September and in December. At the end of each quarter of the year, not on the last moment of the month, but within that month. There is a given date. Until then, you have to pay it. So they give you 3 months, nearly 3 months, in order to earn that quarter of the money, so that you can make the prepayment. It would be rather harsh to ask it at the beginning of January, because then you had no time to earn the money. But in the end of the quarter of the year, you probably had enough time to put enough money aside for the prepayment. Now, naturally, the calculation of the estimate on last year's income is either correct, then no problem, or it's too high or too low. And the taxpayer has, during the year, the right to apply for a downwards correction of the prepayments if the income of the current year is probably lower. Now, there you must be careful, because if you give the information, the current income will be worse than last year, my income will be lower, then you give information to the fiscal office, and that leads to a lowering of your tax prepayment, so to a tax advantage. And now if you give them wrong information, this would be lying to the fiscal office, obtaining a tax advantage, and you could foresee that it would be wrong, so tax fraud. So you should be careful, but you can apply for a lowering of your tax prepayments if your economic situation worsens considerably, so that you say, I'm sure that my annual income will not be as high as last year. On the other hand, you even have the right to apply for an increase of your tax prepayments if you expect that your income will be higher and you want to get rid of the risk that you have a high final payment to make, or for other reasons. But you are not obliged to inform the fiscal office and to apply for an increase of your prepayments, at least in the most situations. Probably when they lowered your prepayments, they usually told you, if the situation reverses and gets better, please inform us, then we can lift it up again, the prepayments. That's just fair. But usually you are not forced to inform them that your current year is better than last year. That's then a case for the final tax declaration. Yeah. Now let's focus a bit on the most important prepayment, which is made, the wage tax, because that is probably affecting half the population or half the grown-up population, because nearly everybody goes and gets employed somewhere. The basic approach for wage tax is rather very, very simple. The idea is if you earn a certain wage this month, you will probably earn the same wage each month. So we just calculate how much will you earn during the year. Plain and simple. Let's start. Your salary for January, which your employer has to pay out for you, is a gross income of 4,000 euro. Now that allows a prognosis. If every month you get 4,000 euro, you will end up with 48,000 euro. Now you can deduct at least 1,000 euro expenses. That's the minimum amount in section 9a EStG, so you can deduct it. You could even probably deduct some other minimum accounts, which by the official computation and prognosis sheets issued by the fiscal ministry will be included in the computation already. But this, ladies and gentlemen, makes the case too complicated. To illustrate the principle how it works, let's just do it this way. 4,000 euro are this month, so 48 will be a full year. Okay, you make some deductions and you end up, let's say, with 47,000 euro prognosis for your annual taxable income. Now you look up how much money that brings along as income tax burden. And it would be in 2021, 10,852. So our prepayments must be designed in a way that after 12 months prepayments, you have prepaid 10,852. Simple approach. 10,852 divided by 12, and that is the prepayment for each month. 904 and some cents, so I rounded it up to 905. So if 905 is kept back from each monthly payment, then at the end of the year you will have made sufficient prepayment to cover your probable income tax for your annual salary. So your employer would issue a calculation which demonstrates how your net wage comes, or how your net wage is resulting from the law. I owe you 4,000 minus prepayment made to the fiscal administration for wage tax 905. Remaining amount 3,895 or so, minus prepayment which I have to make in your name to the social security system for health insurance and pension insurance. And so another deduction will be made, not our topic, and so that explains why you in the end get a strongly reduced amount paid out. But on the other hand, you are rid of most worries and financial burdens because your employer undertakes to pay them for you in advance. The wage tax computation always follows that simple logic. Your monthly salary of this month taken by 12 is a prognosis for the annual income, minus the allowed deductions of, let's say, 1,000 or so, but that complicates matters. Let's forget that from now on. The basic idea is what you earned this month will be the same throughout the whole year. Your employer is not allowed to modify the rules for the prognosis. So even if your employer has positive knowledge to the contrary, they have to estimate you get 48,000 or so. Now, no deviation is possible if the fiscal office has not individually certified that a deviation from the standard rules in your case is allowed, or if there is not an explicit rule for especially this case in the law. There is a database where the personal information and data of each employee is made available to the employer. The data which you have to take into account in the computation of the wage tax computation, but what is not certified there in the database does not count. Otherwise, you would get punished as an employer. No? Good. This simple approach can lead to a prepayment which is rather too high. Imagine you have an increase of your salary during the year. So in my case now, from January to June, you get 4,000 euro, and from July onwards, your salary is 5,000. Congratulations, you are rather good at negotiation. So in that case, for the first 6 months, the prepayment is calculated on an estimate of 48,000 or 47,905 per month. In the last 6 months, the estimate is based on an annual expected salary of 60,000. Now I forgot the deduction of the 1,000 minimum income related expense, but you know the principle, and we are talking about the principle here. So 60,000, let that be the estimate now. That leads to a tax of 16,063, and so 1/12 of it is the monthly estimate for the needed prepayment, 1338 per month. Now, you have prepaid during the last months on the basis of an annual income of 60,000, but your realistic income is only 54,000 because in the first half of the year you earned 6,000 euro less. So your total tax will only be 13,575. That's the appropriate tax for 54,000. But you prepaid probably more. You prepaid 6 times 1,338, and you prepaid 6 times 905, and this is probably more because you prepaid for half of the year on the basis of a higher income which you really had. Okay. So you probably, when you hand in your tax declaration, get a refund. This is the way why German employees always are called up by tax advisors associations, or even why the ministries or by trade unions to hand in their tax declaration after the end of the year. Most of them get a refund when they hand in the tax declaration. This was now the simple case. Now the prognosis, how much income somebody will have, is a bit more tricky when the taxpayer is married and is taxed under a joint assessment rule, the splitting tariff. Because then your tax is not only based on the income you have, but also on half of the income which your spouse has. So there you need a prognosis on the income of both. But your employer only knows your personal income, and probably you're not interested in disclosing your personal income or the personal income of your spouse to your employer. You don't want your employer to think, okay, spouse is rather poor, or made a very favorable marriage. Spouse is really extremely rich, so rich. You want to keep that a secret, probably. Data protection, privacy protection. Now the wage tax prognosis needs some standardized way how you can deal with the problem. How much will probably the other partner earn? And the problem also exists with other constellations, with the prognosis or with the chaos. For example, what happens if one and the same taxpayer has 2 jobs, 2 employers? From Monday till Friday, I work at McDonald's, full-time job. And on Saturday, I have a second job, doing some security job in a football club also. Don't know. There they also pay me. And my second employer also has to withhold withholding tax, wage tax. And now the problem is the usual wage tax estimates include naturally your basic allowance, and they include the area where you still have a low progressive rate. And now if your second employer also calculates the wage tax on the basis of a basic allowance and low rates, you get during your prepayment calculation two basic allowances and you only have the right to one. So your prepayments would be far too low. It would be probably a financial catastrophe because you would have a huge final payment to make after you hand in your tax declaration. That must be avoided at all costs. So for people having two jobs, there are special mechanisms. The second employer is no longer allowed to calculate the tax based on basic allowance and lower tax rates. The assumption must be we need high tax rate brackets to calculate the second wage tax. And so in the end, you end up with standardized assumption sets how the taxpayer has to be treated, so-called wage tax clauses. Wage tax clause 1 is simple. You are not married and this is your first job, so you just are taxed according to what I explained just now. 4,000 this month, okay, 12 times this, 48,000 will be your total annual salary minus allowed deductions, and that settles it. That will be annual tax divided by 12 leads to your wage tax. Wage tax clause 2 is rather a peculiarity. You are unmarried, this is your first job, but you have a child and you are the sole parent who is responsible for education. Then you might get an additional personal allowance, and so that modifies your wage tax prepayments. Wage tax clause 3 is you are married and have the right to joint assessment. You are treated as the first partner because it might be the first working partner will get two basic allowances and will get the lower tax brackets attributed, because it might be that your second partner stays at home, is jobless, or is not interested in a job, so that the prepayments for the first married partner take into account this is a married couple. You get the maximum reductions of the tax attributed directly in that case, because married couples otherwise would not get the full adequate prepayments. They would be taxed on a too high basis. If only one of them works and only one basic allowance is granted, that would spoil everything. It would be an unreasonably high prepayment. So tax clause 3 can be opted for. If you have tax clause 3 as a first partner, then the other married partner gets tax clause 5, which signalizes the employer the basic allowances are both gone already to first spouse, and the low income rates are already blocked by first spouse. And so tax clause 5 assumes that the second partner is already arrived in that area of income where you end up with higher marginal tax rates. So the prepayments there are higher. In the middle, you also can opt for tax clause 4. That's basically the same as tax clause 1. You are married, but every partner claims an own basic allowance, so the prepayments are made nearly in the same way or practically in the same way as if both are unmarried. Now, if one of them has a higher salary than the other person, then the splitting effect is absolutely not taken into account during the prepayments calculation. That is, the partner with the higher income pays a high progressive rate, which is higher than the rate which would be appropriate for the average income, because that partner with the higher income is above the average income of the two spouses. And so that partner will be taxed with a progressive rate which is higher than necessary. But if both have approximately the same gross income, then their personal tax rate will probably be the same. Then tax class 4 is the best estimate. Nevertheless, in the final effect, it all doesn't play a role because the wage clause is only a prepayment during the year, and after the year, the married couple hands in a joint tax declaration. The final tax will be computed, which they owe to the state, and then the wage tax prepayments are all added up, and they only have to pay the rest which remains, or if they prepaid too much, they get the exceeding amount refunded. This is the way as it works. Last tax clause would be tax clause 6. This is for a second job or a third job or so on. It does not matter there if you are married or not. The prepayments there are always be made on the basis of the highest marginal rates. Very high marginal rates, naturally, not based on 45% if it's not reasonable that you end up with 250,000 annual income as a married couple for both partners, because 45% is rather unrealistic for people who are employed, at least at the beginning of the second job. So that's not realistic. But there you will be charged high tax rates that they in most cases cover the necessary payments. So when you take up a second job, probably your prepayment, and you have a total low income, a badly paid first job and a badly paid second job, then your prepayment under tax clause 6 for the second job are probably too high. So if you hand in a tax declaration at the end of the year, you probably get money back. Sometimes we have cases where the prepayment situation is simplified. For example, in some cases, the law says, okay, let's claim a prepayment and then forget about the whole event, because otherwise it would be too complicated, or we want to subsidize the thing by making it simple. Might save bureaucracy or might be an incentive to make certain behavior more attractive to employers and employee, depends. The most famous simplification scheme is the mini-job regime, which most of students know. In case of a mini-job, the employer can take over the payment of the wage tax for the employee. So in that case, the wage tax is not deducted from the wage, but the employer puts it on top. It's then a tax paid by the employer and owed only by the employer to the fiscal office. The employee cannot make liable for it, and surprise, the employee has nothing to do with the tax. So the event is then regarded as definitively taxed. So if you worked in a mini job, you won't get 400 euro. The situation will be as follows. You get the wage of 400 euro without any deduction, and your employer pays a wage tax of, in many cases, 25% on top, flat, and definitively 100 euro. Now they are definitively gone. The student or the mini jobber has not to declare the 400 euro in his or her tax declaration anymore. The event is definitively taxed, dealt with and done with, gone and forgotten. And surprise, you are not even allowed to declare the 400 euro from the mini job. And you cannot claim the wage tax as your prepayment. It's gone. Everything dealt with. File closed. You never get back that money, and your employer never gets back that money. So definitively gone. The seemingly existing advantage of that regime is the student now is happy because he or she thinks, I got 400 euro promised, I got the full 400 without deduction. Nice. On the other hand, if you had not opted for the mini job regime, it might have been that your employer said, okay, the job costs me 500. So if you take over the taxes and are willing to work under the regular tax regime, I might be willing to pay for you the full 500. In that case, it might have been better to work under the regular rules, pay the wage tax on your own account, get them credited at the fiscal office, hand in a tax declaration after the end of the year. They find out, oh, you didn't exceed the basic allowance, so you owe us a tax of 0. You prepaid, let's say, 1,200 euro. Here's a check, you got them back. Might happen. By the way, the mini job regime has also some advantages in other areas. For example, very often the employer also saves additional costs for social security contributions, and that makes it very often very simple and attractive for an employer to only ask for mini job people. So it might be that for non-tax reasons, the employer says, no, you don't get 500 on the regular scheme, you only get a mini job offered by me, 400, and I pay the tax. Then there are other advantages for the employer. And you can only take what you are offered. Sometimes employers say, okay, you can either opt if you want to work on a regular basis with the regular wage tax, or if you want to work under the mini job scheme, and then we talk about the wages which you get in the one or in the other case. Then they give you the right to choose. Important is mini jobs is limited to a certain amount. It's only possible for relatively small paid jobs. That is the reason for a mini job. And you are not allowed to accumulate more money from several mini jobs than the monthly limit, which is for one mini job. So you can't multiply the advantages from multiplying the jobs. Well, the second way or case where some things are very often simplified is where monetary advantages are granted by employers to employees, for example, so-called perks like free meals in a cafeteria for every employee, or subsidized meals. The meal costs 5 euro, you only need to pay 2 euro or so. In that case, very often you have standardized values and you have even a simplified lump sum based wage tax regime, where also the employer says, I pay the wage tax and I don't charge it to the individual employees. And where the tax law then says this prepayment, this lump sum wage tax, pauschale Lohnsteuer, is definitive, and the whole event is definitively dealt with. No tax declaration duty, no possibility to include the meals received and the wage tax paid on them in your individual tax declaration. It's all gone and done with. The idea behind such a lump sum prepay or wage tax regime where the employer pays the tax and it is definitive is usually a simplification. Imagine if you get subsidized or free meals in a cafeteria and it would have to be charged individually as a part of your wage. Then imagine you go to the cafeteria in a lunch break, 30 minutes, and now you want to have a meal. 5 euro. You only have to pay 2 euro. Then the person at the cash desk says, okay, who are you? I'm Mr. Smith. We have 3 Mr. Smiths on the list on employees. Which Mr. Smith are you? Well, is that your business? Yes, it is mine. I have to calculate the financial advantage. Which meal do you get? 5 euro. Okay, or here, 2 euro you pay. Our costs are 5 euro. 3 euro I have to note down because that was today's financial advantage for you from the subsidized meal. You also take a Coke. Okay, it's 120 which you pay. We pay 140 for it if we include all the costs, so this is an additional financial advantage for you of 20 cents. Now imagine how long your lunch break would be. It would be a whole bureaucracy. You would spend 20 minutes in an interview with the person at the cash desk. Who are you? Do you have your passport available or your firm's identity card? Let's calculate how much financial value you got for free now with that meal. Okay, yesterday you were also here, and so on. It would be a complete chaos, and that is a reason for a simplification. You just say, today, let's say 200 people from my firm visited the cafeteria because I know that I sold 200 meals. And every meal was subsidized in the average with €2. That means today I gave financial advantages in form of meals of €400 to my employees. Let's pay the standardized lump sum wage tax on top, let's say €100 on top. Now the question with all the meals is definitively dealt with. Nobody needs to care about who got which meal, who showed up today in the cafeteria and who went out and ate somewhere else. All that is now no problem at all. No, that's the reason behind such a simplified lump sum based system where it does no longer matter who got which amount. That's sometimes a reason for a simplified taxation scheme. And very often you also offer a possibility to a definitive lump sum payment for wage tax by the employer if you want to make certain things more attractive for employers for social reasons. For example, if an employer, pays an insurance for you, which is perhaps desirable, it might be that the employer can take over the tax or so at a relatively low average rate, and then that might be an incentive for the employees and the employers to opt for such an insurance. So you you motivate them to undertake a socially wanted behavior. Very often you also have similar simplifications when it comes to limited liability taxpayers. Because they are difficult to catch when they once are abroad, and very often it is too complicated for them to fill out a German tax declaration. So in many cases, you just say, at least in the most relevant cases, who makes a payment to a limited taxpayer has to withhold a bit of the money, transfer it to the fiscal office, and then in case of the limited liability taxpayer, everything else would be too complicated. The whole affair is then all over and done with. Forget this event now. There will be no tax declaration necessary and not even a tax declaration allowed. Tax declaration will only be asked for income which remains, income which was not covered by a withholding tax. For example, if our foreign taxpayer also has income from a house in Germany or so, then an assessment is made for the income from the house, but the license fees, the capital income, or the wages are already done with by prepayments in form of a withholding tax. Forget about this. So that can very often be done. For example, in a hypothetical scenario where a taxpayer from abroad comes here as an artist or pop singer, the wage promised would be 100,000, and the person organizing the concert has then to withhold a prepayment of 15%. 15,000 is 58 EStG, and the pop singer gets the rest and then goes home. Now the German fiscal office and German law says, okay, if a limited taxpayer received a payment under a withholding tax regime, okay, let's say this is okay. 15,000 have been withheld. 15,000 is the amount. No tax declaration necessary anymore for that transaction. It's all over and done with. Only if that pop singer also has a business in Germany or a house in Germany for this, because this is too individual, we still need a tax declaration. But the wage for the event in Germany is already done with and no longer relevant. Yeah, so that is where you have a need for simplification, and that is the explanation for these additional withholding taxes for foreigners, which I already mentioned, 15% on wages for artists, entertainers, sportsmen, and similar persons, 15% on license fees, so royalties paid out to limited taxpayers, and 30% fees paid to the members of a supervisory board who do not live in Germany. Oh, yeah, that's it for today, ladies and gentlemen. Do you want to see that promising, hopeful, nicest slide of today again? It's this one. End of presentation. So that was everything for today. I thank you very much for watching. I hope you enjoyed it a bit. One cannot reasonably expect that you enjoyed it much, but at least a bit. Or if you didn't enjoy it at all, then enjoy that it's over. So thank you again for being faithful to this channel. Hope to see you again. Hope you get a good impression of what it's all about. And well, that's it for today. Don't know what to say. So let's just say it's all over and done with. And the simplified procedure would now be, let's just press the button and end the video. And then we see each other again. That might be a good solution. Okay, and